Hello, welcome back. Today we're going to be talking about minimizing risk. How can we reduce the risk in the market and every single trade that we make. Some little key tips that we're going to talk about on here that you can implement into your trading straight away, just to save you a few dollars in every single trade that you make. Okay, first of all, the key to longevity in the market is to reduce the amount that you risk, especially as a new trader. If you lose 50% of your account, which will happen at some point, it's very hard to pull that back. In fact, you would need to double your account the next month just to make back your 50% loss from the last month. So risking less in every single position that you trade is very important. Because we use leverage as a tool to make us more money when we are correct, it also makes us lose money faster when we are wrong. Always place a trade with the intentions that it will move against you. So how can we place a trade and lose as little as possible? That's what you always need to ask yourself. Always assume the market's against you. So how are you going to save yourself a lot more money by not risking as much? Alright, so first of all, number one, decrease the leverage by changing your position size. Okay, so if you're trading one full mini lot, if you don't like a move for a particular reason, even if it's within your 30 pip range, if you're not 100% sure about the move, you could halve your position size. So instead of risking 3% in that trade, you're only going to risk 1.5% of your account on that trade. That's number one. That's very easy. Number two would be retrace to a Fibonacci level. Let's just say you had a little move, and then you wait for a Fibonacci retracement before making an entry. I'll show you a demonstration of that in a minute. Another one would be number three is retrace to a trend line. So after you've had a move, a trend line break, you may wait in the price to break through the trend line and come back down, test its support level before continuing on the relevant direction after the trend line break. And the fourth one would be retrace of the candle. Every candle formation that you see, up and down every single bar chart, most of the time the price will retrace about 25% back up, even if it is trending down the way. Okay, so the market moves in up and down fashion, up and down, even to the 1 minute chart. Well, maybe not this one. There you go. Up and down, up and down, up and down. This is a 1 minute chart. Okay, so you can imagine on a 1 hour chart, this might be a 1 hour candle, 25% retracement down before you get the next hour, up, 25% retrace down before continuing on up again. So that's what we call retrace to the candle. Okay, this is this up and down fashion. So when you get a candle formation, you can always guarantee about 85% of the time that the price is going to retrace back up around 25% before continuing down towards the trend. Okay, so that's the four minimizing risk tactics that you can use. So number one, decrease the leverage by changing your position size. Number two, retrace to Fibonacci. Number three, retrace to a trend line. And number four, retrace of a candle. I'll show you demonstrations in a minute. Even a 5 pip retrace can save you a lot of money and increase your profit to loss ratio as well, which can be very beneficial for your trading account balance at the end of the month. I'll show you this right now. I've already laid out this little demonstration for you so I can explain it nice and clear for you, just to show you that the power of just 5 pips, what that can do for you. So basically, we had the trend line move here, coming up the way, based by this A formation, B, C, D. Okay, so the market made a move up This is a 1 hour chart, and I was looking to, well, hypothetically, we were looking to short the market at this time. So we were waiting for a retrace up before shorting the market. So we had this move up, and drawn by these 2 points with the A and the C, we had the 2 points, and then we had a trend line break right here. Now on this candle right here, you can see the close came through the trend line. That was a trigger to enter a trade, with this level being the stop loss, a few pips above that high. It's also above that high right there, and then the take profit level was down at the low of this move. That would be profit target number 1 at least anyway. Okay, so the green horizontal line, this marks the entry price based on this candle, and then the white horizontal line represents a 5 pip retracement from the entry. I'll just show you right now. That's 5 pips to that level. So we're going to be talking about waiting for a 5 pip retracement on every single trade to make it more beneficial for our profit to loss ratio. Okay, so I'm just going to go through here and just talk about a few things. Entry price up to the stop loss, in this case 25 pips. Okay, and from the same entry line is a 55 pip profit. Okay, that is a 2.2 to 1 risk to reward ratio. Okay, so for every 1 that I'm risking there, I'm getting 2.2 back in profit, which is a nice trade, and you should take that if that turns up. But what we're going to do, and what you should start to implement right away, as of when you finish this video when you're trading, start doing this. Wait for a 5 pip retracement. Okay, so now based on the same stop loss area, but a 5 pip retrace entered manually in the market, that will be giving us a 20 pip stop loss right there. Take profit level still the same, okay, but we're a bit further away from it, so it's now 60 pips. Okay, 20 pip stop, 60 pip profit. Okay, so we're risking less and gaining more. That is now a 3 to 1 risk to reward ratio. So for every 1% that we're risking, we're gaining 3% back, which is very favourable. Okay, getting a 3 to 1, that's brilliant. Show you a little something here. This is based on these calculations, the 2.2 to 1 risk to reward ratio and the 3 to 1 risk to reward ratio. What I've done is, based on the 25 pip stop, I've put in 7 losses and 3 wins, and same for this. For the 3 to 1 risk to reward, we had the minus 20 pip stop and 60 profit. Now if you were to lose 7 times out of 10, okay, that's these trades 1 through to 10, on the 2 to 1 risk to reward ratio, you would just be in the negative. Okay, so 7 losing trades, 3 winning trades at 2.2 to 1 risk to reward would net you minus $10. Same scenario, but reducing your risk by 5 pips on every trade would give you plus 40. Okay, it's not great, but it's not devastating, and you never actually lost any money then. So this is the difference, 5 pips in every single trade. Okay, it maximizes your profit potential and it minimizes your risk. Okay, you could do the maths. If you were to win half the time, lose half the time, so 50% winners, 50% losers on both sides, what it would net you on the 2.2, it would net you $150, and on a 3-to-1 risk to reward, it would net you $200. Okay, this is all simulated results. It doesn't always happen that way. Things do change in the market. You won't always get the stop losses, and you won't always get the profit targets you expect, but this is just for illustration purposes, so I hope you know that. So I'll show you a couple of demonstrations. We'll go to this Euro 4-hour chart, and let's just say, for instance, we're looking in hindsight here. You know, this is back in November. So let's just say that we were looking to go long, and we were waiting for a downtrend to occur before buying at a nice low level, but waiting for an entry price. In this case, we got an entry price via this broken trend line on this candle right here. Now that would be a stop loss of 95 pips thereabouts. Let's just say if you didn't want to risk that yourself, that's perfectly fine. A few things you can do right here, like we spoke about. We had a retrace of a candle. In this case, this candle right here actually retraced about 75% of the way, roughly, of the body. But you could go for a 50% retrace. You might not always get in, but I would enter at 25. So you would save yourself 5 pips easily. Let's see how far this one came down. This one came down 14 pips before it closed again. All the way to the low, 26 pips. Okay, so you could have saved 26 pips on this trade on the next hour. Okay, so that was version 1. Another thing you could do is from the top to the bottom of that little signal move, wait for a little retrace, enter on the 23.6%, pretty much 25%. Sometimes it will come down to 38, sometimes 50, sometimes all the way to 78.6, and then in some other rare cases I'll do a double bottom before bouncing back up. If you see a double bottom, that's brilliant, but it equally works well off the 78.6, 61.8, 50%, 38.2 or 23.6%. It all works as good. The key is trying to shave some pips off what you're actually going to risk in the market. Okay, even if it's 5 pips like we talk about, brilliant. In fact, after this little nice move up here, from that move, started moving back down. You might be starting to get a little bit nervous right here, especially when the candle's all the way down here with a full body coming right down, coming to touch the 78.6 for the first time. You could just imagine, oh, this is going to be a losing trade. When the price comes to a 78.6 after a signal to buy, you could enter your trade here at very tight stop. Let's measure the distance from there to down there, so we're talking 40 pips. That's a big difference from 95, wasn't it? So we've more than halved what we've risked. And then your take profit level, let's just say we're going to take profit at this high based on here. What you've just done is potential profit target from the entry candle of 126 pips, and now it's just changed from a lower entry price up to the same profit, 185 pips. Okay, so it's quite considerable what the difference can be if you just wait for a little retrace. I mean, in this case, this one took many hours. I mean, this is a 4-hour chart, and it was 14 blocks of 4 hours, so a good couple of days there before this actually happened, and then it took a few more days to go up to the profit target. But if you're sure in that trading system and that's what it's going to do, then you know you should feel confident about it. Okay, that was one entry. Point out this, just like we were showing on this little trade here, how I drew the little high there for the take profit for that trade. Look what happened afterwards. What becomes support becomes resistance, and what was resistance becomes support. It's called change of polarity. So support, resistance, and as time went on, broke through and then became support again, and support. What great buying opportunities for these, just always keep your eye out for them. Anyway, I'm going to talk about this little trade set up here. We're just going to assume that we're going to go short, so we're going to wait for a long move up with a trend line break. So signified not by this because it's too early and it never broke through, although it was right on the trend line. Next candle, it opened up through it, so you might be wanting to trade. A lot of people probably would take that trade, but not myself. I would wait till that close. But the close was very close to the open. 4 hour chart, so 98, 100 pips stop loss there. You could draw Fibonacci in, but I can just tell from saying that's beyond the 78.6. But and it went a bit beyond the trend line, tested the resistance of it. You could almost call this a little bully candle. A price rush right through it, and then a price crash straight back to the other side before continuing on down. But if you stuck to your rules, like doing a 25% retracement, you wouldn't have got in there. But if you just waited a few hours and just entered the market manually on a price that you were happy with, put an entry in for here and just hope, basically. There was nothing really to signify that we've had a Fibonacci or a retrace of a candle, but this is what happens sometimes. The price comes right up just to test it. But yeah, enter the market manually if you can. If you noticed there was a trade set up, let's say if you weren't at your computer here, you were out and about in the town doing a bit of shopping or whatever, you come back and all of a sudden the price is up here. Now, although you've had a confirmation of a trade here, I'd be more than happy if the price was up here. I'd be more than happy just to enter the market, even if it's beyond the trend line, and risk a 55 pips at half my leverage position, which would be a 0.5 for $1,000 account. And I would just enter the market manually like that. You've already had your confirmation, but you've got a better price than what a lot of other people had the opportunity to get in at. So that's a good thing. On to the next one. I think we've got a little demonstration on the US Japanese yen there. On the assumption that we're going to be on a short trade, waiting for a long move up and a trend line break. We got it, and then that wasn't really a clear indication to sell. The next candle definitely was, but it was quite a long way away from this candle, so automatically the stop loss, well, in this case it's 30 pips, which isn't actually so bad considering it's a 4 hour chart. But the United States dollar Japanese yen is really losing its volatility right now, so the moves are very, very small. Even on a 4 hour chart you can get in a 30 pip stop. So that actual candle was a 13 pip candle. Most other charts, something like that, would be a 30 pip candle. So let's just say if that was a little bit beyond your reach, like we said, this price came up. It didn't test the support of the trend line in this case. It would have came up to Let's see if Fibonacci's came out top to bottom there. Yeah, there you go, bounced off the 78.6 and then crashed back down again. So Fibonacci worked in this case, and you would have saved yourself where was that? You would have saved yourself 17 pips based on that method. Now it doesn't always go to the 78.6. Waiting for it to go to the 78.6 is risky. The likelihood of it turning before that is a lot higher, so I would definitely enter the market before that. But if you ever come across your charts and see this trade confirmation with a price rush up to 78.6% Fibonacci, take a trade if you want, of course. Right, so that's a few demonstrations. Just a little chat about when you get a setup, instead of going for straight into the market execution trade like we would normally, you can either place a pending order to enter you into the market at either a 25% retracement to a Fibonacci level, or just wait for a 5 pip retrace of your entry price. Like we talked about, 5 pips can actually mean a considerable difference to your balance at the end of it. It'll protect you from not as worse losses if you're on a losing streak, but if you're on a winning streak, it can definitely benefit you in that respect. So implement that from as soon as you finish this video. When you see a trade, wait for that 5 pip retrace into the market. Okay. Anyway, on the next video we're going to be doing a couple of demonstrations in a live trading environment on minimizing risk. We'll do on a demo account. I'll just throw up a few trades, but I'm going to wait. It's 8:30 GMT time just now, so the markets are getting pretty low volatility. There's not going to be much movement in the marketplace just now, so I'll come back tomorrow and we'll find a few trade setups. You know, it's not necessarily based on any systems or anything like that. We're just going to put this stuff into practice in the Fibonacci retracements, 5 pip retraces and retraces of a candle. Just show some live demonstrations. So go ahead and watch that one right now, and I'll see you over there. See you next time.